We are watching oil bounce a little bit here, but closing it around the lowest levels since 2021. We've got David McAlvany, CEO and portfolio manager at McAlvany Financial. And David, this move to below 70 came quite suddenly in the matter of weeks. Do you think it's overdone? Do you think there's more to go? Where do we hang out? How do you think about that?
Yeah, well, I think the price risk is now to the upside. We continue to see pressure build in the futures market and a tremendous short position there, which, if forced to cover for any reason, could create just as much energy in the upside as we've seen over the last few weeks on the downside. But fundamentals are not as weak as prices suggest. And, I think a lot of the downside energy is focused on the significance of Chinese economic growth and speculation that they're moving to a lower gear. 5% is not a reasonable expectation, and Wall Street firms are fairly unanimous in downgrading their growth prospects.
So help me understand how you're positioning the portfolio. Are you buying companies that thrive in $80 environment, or are you taking this price maybe a little bit higher and saying who does well in this environment?
I like companies that have long-term contracts in place for moving product and are less sensitive to the commodity price itself. So for us, enterprise products partners, Williams, Kinder Morgan, these are our largest energy allocations for clients, and we like them because they've got great free cash flow generating ability. They've got strong dividend growth. They're internally funded in terms of CapEx, very strong free cash flow, and very strong and constructive balance sheets. So even with a lower energy price, they've got less downside attached to them. So from a risk-reward standpoint, they are the place that we want to be.
What would it take for you to look at the producers?
Yeah, I mean, I would want to move towards more opportunistic positioning if we got pressured into the low 60s. If we're talking, WTI in the upper 50s and Brent in the low 60s, I would look at that as sort of an opportunistic pricing. I think one thing to keep in mind is the significance of the sort of uniformity in the commodity space. Your industrial commodities have been very weak, and so Brent is not alone in the pressure that it's under, and I think some of that has to do with anticipated Chinese economic deterioration. The question is, does that extend more globally? And that may be what we see showing up in the traders' positioning, where there's some question as to whether or not U.S. labor markets weaken from here. And we've got some indicators, the uninversion of the yield curve, the SAM rule, and of course they've been around and signaling recession for some time, but the leading economic indicators, put those together as sort of a mosaic, and you've got some suggestion that we might have a recession here in the U.S. as well. Although current economic numbers are relatively healthy.
So, help me understand, because you're taking a cautious approach. You're not dismissing the economic data, but at the same time, you're willing to get a little bit more constructive on energy.
I'll get more constructive on energy as long as we have a further pressuring in price. If I can establish basis, with crude at those lower levels, I do think that you're talking about 2025 projections of trading to $70, $80 a barrel. And so, that would be a very opportunistic play.
What about copper? Another read on sort of global economic growth. It has pulled back significantly from the peak in May. Are you cautious on the sector? I know in the past that you've liked some of these copper-exposed equities. How are you thinking about it now that we seem to have at least stabilized?
Yeah, well, I do think that between copper, nickel, iron ore, the theme again is China in the short run, and global growth in the long run, and the use in terms of sort of the EV trends and the move towards electrification. You can make a very strong case and a bullish case if you're a long-term investor for copper equities and for your industrial commodities in general. I'd be cautious in here, probably the next 3 to 6 months. Caution is warranted in any of your CapEx commodities.